Okay. It's new. Yes, some examples, sure. Okay, fine. I will give you more explanation. Okay, interest rate swap. Look at the Bloomberg screen. Here, it's July 29 of July 2021 when I use the screen by Bloomberg. What can we see here? I will. Sorry. Okay, use my pen. Okay, here. Okay. Do you see my pen? Do you see an arrow on the blackboard? Please tell me because it's better than going to my message. Do you see the arrow? You tell me yes or no. Nobody wants to tell me yes or no? Nobody?
Yes, we can see that.
Yes, you can see. Fine. Okay, so United States is because I will give you interest rate swaps on dollar. Okay, so United States. Here it's written semi-annual. That is, if you make a swap is an exchange of flows. For instance, if you make a swap 10 years, this one, 10 years, okay, each year 1, year 2, year 3, year 10, you will pay a fixed interest rate, the same, fixed F, determined today, F, and then F at the end in 10 years. And you will receive from your bank a variable rate, which is the LIBOR in the screen here, the LIBOR 6 months, which is a variable rate on the US money market for 6 months horizon. It's a short-term interest rate. And here at the end, in 10 years, you will receive a variable rate, which is the LIBOR 6 months. It's the reason why here, the swap it US dollar, semi-annual, it is every 6 months, okay? So what is very easy here to understand, I hope so, is if you are a company and if you're in balance sheet, you have your balance sheet of the company. Here you have your debt on the liability side. Imagine you have a debt of $100 million fixed. Variable. Okay? That is only on this debt, you pay each 6 months the LIBOR, the short term, the 6 months interest rate in dollars. So you have a risk that the 6 months interest rate moves up. You want to hedge this risk. You make a swap, this one, with your bank. You take Vietcombank, I will pay you each year a fixed rate, maybe 1.30%, and each 6 months you will give me just 6 months LIBOR divided by 2 because it's a 6 months interest rate, but you will receive that. So on your debt, you will pay the variable rate, but on the swap, you will receive the variable rate. So you offset. But on the swap, you pay fixed. What does that mean? That means that a variable rate debt plus swap paying a fixed rate equals what? Equals a fixed rate debt. Okay? So if you are in debt on a variable basis and that you make a swap paying fixed receiving variable, you are in debt immediately on a fixed rate basis. Okay? So now swap rates here, okay? 1 year, 2 years, and you can make swap till 30 years. If you want to make a swap with a 10 years maturity, here you have to pay it's bid and ask, as I learned you yesterday. Okay, so if you pay fixed, you will pay this on the right side. If you receive fixed, you will receive a lower interest rate. So here, the fixed rate, I will. Okay. Okay. If you look at the 10-year swap rate, it's 1.328%. Okay. You make a swap, you will pay to the bank each year 1.328% of the nominal value of the swap. If your debt is 100 million, you make a swap on 100 million times 100 million. And each year you will pay that. And you will receive each 6 months, semi-annual, the LIBOR 6 months. Okay? So if you have a debt on a variable basis, you make a swap paying a fixed rate today or July, at the end of July, same thing. The swap rate was 1.32%. You receive variable. You are no more indexed on a variable rate because you pay on your debt, you receive the same thing on the swap, and just you pay 1.30%. So it's very interesting today for US firms because they can lock in a fixed rate of 1.30%, 1.3% during 10 years. It's a very low interest rate. You understand that? Okay, so let me just okay. So basic use of interest rate swap is changing in 1 second a fixed or variable rate in a variable or fixed rate debt. Okay. Example, next slide. Maybe, okay. I will use my pen. You are in debt. Okay. It's 0 time 1 year, 2 years, 3 years, 10 years. You borrow today, step 1, on a variable rate basis to your bank, to a bank. So the fixed rate, you borrow on a variable rate basis. You borrow on a variable rate basis, Everybody understand that, on a variable rate basis. Okay. For instance, 6 months. So you receive today 100 million because you borrow immediately. You will pay X 6 months. It's 6 months. It's 18 months. You pay the LIBOR 6 months. Okay, the short-term dollar interest rates 6 months, 6 months. Here 6 months. Here 6 months. Okay, till the end. And at the end, 6 months, you will surely reimburse your debt paying 100. That's a debt on a variable rate basis. I borrow 100, I receive $100. I will reimburse in 10 years $100. And each 6 months, I will pay the 6 months interest rate. Okay, that's step 1. You did that. But now someone graduate from CFVG, from your institution, says, oh, that's very stupid to be in debt on a variable rate basis. Because if the short-term interest rates move up, you will lose a lot of money. Because maybe in 2 years, at the level of the 6 months, could be 7%. So you will pay 7%. It's stupid to do that. I prefer to be in debt, to borrow on a fixed rate basis. How can you do? As now you had a very good training on swaps, you say, oh, I have the answer. We have borrowed. That's in the balance sheet. Okay, it does not move. It will stay during 10 years in your balance sheet. But with the same bank or another bank, you decide to make a swap. 10 years, okay, paying each year a fixed rate, today 130%, around 130%, 130% year 3, and in 10 years, year 10, 1.30%, and each 6 months, you will receive the 6 months interest rate, 6 months, 6 months, 6 months, 6 months, and at the end, 6 months, okay? So that's a swap, paying fixed, 1.30. We saw that today, 1 month ago, the swap was trading at 1.30%, very, very low interest rate, and receiving variable 6 months interest rate. So now if you add, that's on your balance sheet. That's what we call off balance sheet. Why off balance sheet? Because it's what we call a derivative. So like it's a derivative, it's not in your balance sheet. But if you economically add the two exposures, you see immediately that on the swap, you pay your bank a fixed rate, 1.30%. Okay, on the swap, you pay that. Okay, you receive the variable rate, but you have to pay on your debt the variable rate. So that's offset. And then what is remaining, 1.30, 1.30, 1.30, and at the end, you will reimburse 100. So that plus that is equal to what? It's equal to exactly that. I have a debt paying 130%, 130% each year, 130%, and at the end I reimburse minus 100, and here minus 1.30%. So a variable rate debt plus a swap is equal to a fixed rate debt. And if 3 months after, 2 years after, you want to change your debt, you make another swap, paying variable, receiving fixed. And now you will be indexed on a variable rate basis. So swap is very, very useful. It's a huge market in the United States, in the Eurozone. It's a huge market because every company uses swap to manage dynamically its debt. Okay, because and today, especially today, do you know that today we have swaps with an interest rate 10-year 1.30%. Look at if you can look. Okay, look at that's extraordinary. You have here, sorry, I'm not sure. Whoa. Maybe it's better if I do that. Okay. Okay, and again, if you look at the 10 years, okay, here, 1.30%, 10-year swap. If now you want to lock in an interest rate over a 30 years period horizon, 30 years, you make a swap with your bank paying just 1.65%. Really for US firms, 1.65, it's really very low. Okay, so I will go to my message, hoping that there is no technical problem. Again, If you don't see me, if you don't hear me 2 minutes, it's just because there was a technical problem for going from my slides to the message. Okay, so I do that. Send me message to tell me we understood, we need not understood, we need another example, what you want. Tell me if you understood. That's very important to be clear with swaps. Ask questions if you have questions. You don't have technical issue. Okay, one of you is telling I don't have any technical issue. Okay, so I suppose everyone understood very well about swaps. If it's not the case, you tell me or you write, okay? I go back to slides. And now I must do that. Okay. Okay. Now I have an exercise for you with swaps. You are a CFO, Chief Financial Officer, because you are graduate from this prestigious CFVG, okay? Center, I don't know what is it, Franco-Vietnamese, I don't know, G, I don't know, group, maybe, I don't know, CFVG. You are graduate, okay, you are graduate from CFVG. Congratulations. And as you are graduate, you are now a chief financial officer. In US, sorry. And you look at the interest rates swaps. You look at the 10 years, for instance, is 1.30%. You want to hedge your firm against an increase of long-term interest rates. Okay, you don't look at your debt on the balance sheet. Maybe you are in debt on a fixed rate. Okay, but just you look at the swap rates and you observe that they are very low, 1.30. What do you recommend? Send me a message like that. It's an answer I wait from you. You are graduate, so you are very prestigious students. Okay, very good. You are now chief officer in New York, and you are very familiar with swaps. And you say, whoa, the level of swaps is very low. I would like to hedge my firm against an increase of long-term interest rates. What do you recommend? Please, what do you recommend? So to do that, I go to the message. And I want absolutely that you send me a message to give me the answer. Okay? So, okay. I wait for your answer. You have Bloomberg, you see the level of the swap rates, and you tell, I would like to hedge my firms against a rise in interest rate. What do you do? Nobody has an idea or nobody wants to give the idea. One person is writing. Okay, someone, as you can read, say, I make a swap, paying fixed rate, receiving floating rate. Okay, I will discuss that, and after, but I wait for other answers. If you can send me other answers. You can also say, I think that TUI, who has been answering, TUI generally answers very well. She is very well in finance. So as she said, swap paying fixed, receiving floating, I will write the same thing because I am sure it's a good answer because it's TUI who wrote the answer. So maybe you can say, okay, swap paying fixed, receiving floating. If I ask you why, you will say because TUI gave this answer. So as she normally very good, I give the same answer. Maybe she's wrong this time. I don't know. Okay, do you trust TUI? Do you tell me the same answer or do you give me another answer? Nobody wants to answer exactly like TUI? Nobody trusts TUI? Nobody thinks she's very good? No, nobody wants to answer. Okay, I will answer because you don't want to answer. Okay. TUI has an outstanding answer. That's pretty good. So for the next questions, please, you have interest to give the same answer. You wait that TUI answers, and when she has answered, you write the same thing, and you have a lot of probability to get the good answer. But some of you in the previous days gave me also good answers, but now they don't answer anymore. I don't understand why, because some of you were very good also when they answered. So maybe now they sleep, or maybe they have a dinner, and maybe they don't listen to the course. I don't know, but some days ago, I have another answer who is coming. I wait. I wait. I wait. Someone is writing. Okay, I will pay the fixed rate for debt and receive the variable rate. That's perfect also. Yes. Okay, that's very good. Let me go to the good answer. What do you recommend? Normally, it's a very good knowledge about finance. It's a good level. What I teach, it's really a good level. Okay. Okay. So look at first. Sorry. Look at first the swap rates. Okay. The swap quotation on your Bloomberg screen, and you say, oh, the level of interest rate are very, very, very low. Okay, low. Okay. So my advice, sorry, I have to, okay. Okay. My advice is I call Vietcom Bank. I call Vietcom Bank. Vietcom Bank. I say, hello, I would like to make a swap. I would like to make a swap. IRS, it is interest rate swap, okay? Swap, an interest rate swap, paying, maturity, maybe 30 years, paying, do you remember, it's something like 165% each year against variable rate floating. Okay, Tui spoke about floating rate. She's perfect because floating is better than variable. We say more floating rate than variable rate, but it's okay. In banks, we speak about floating, in economics, variable. Okay, you do that. So you don't pay anything for that. You just call and you tell Vietcombank, yes, I will pay each year 165, and against variable, you will pay me the 6 months interest rate each 6 months. Now, in how many years? You do that for 30 years. In 2 years, for instance, in 2 years, the level of interest rates has moved up. And now the swap, 20 years maturity, pay a fix of 3.65%. Imagine. Okay, the interest rate in why? Because Joe Biden, the president of United States, has make a huge budget deficit, has borrowed on the market a huge amount of bonds, so that the Fed, the Federal Reserve Bank, has not bought everything. So the level of interest rate, long-term interest rates, has moved up. And now the 28 years swap rate is traded at 3.65%. Okay, you took a very good decision in buying a swap 30 years, 2 years ago, with a swap rate of 1.65. And then what do? Then you call again, Vietnam Bank. And you say, hello, guy. Do you remember 2 years ago, I made with you a swap paying 1.65, receiving 6 months? And now you say, look at your Bloomberg screen, and the guy in Vietnam Bank looks at the screen and he say, oh, the swap rate is now 3.65. And you say, okay, guy, I would like to sell my swap, to sell it, because you have a swap which is paying each year, it's your swap, 160, 165, 165, and year 28, 165. And the new swap pay 3.65, 3.65, 3.65. Your swap has what we call a positive market value. That is, your swap has a good value, because if you sell it, you sell something, a contract, a derivatives, paying each year during 25 years 1.65, and the new swap pay 3.65. So you tell Vietcombank, okay, I sell you the swap and you give me money. And you have a huge money, but you have to borrow, because in 2 years you have to borrow, and you will now borrow maybe on a 3.65 interest rate basis. You will lose money, but you will get money in your swap. So a method for hedging against a rise in interest rate is making a swap, paying fixed, receiving, as Tui told us, floating rate. But I have a last question about that. What is the amount? The swap was on 100 million nominal value. What is the value of the swap? What is the value of the swap when you sell it? When you sell it to Vietcombank, you must give me money. How much? Okay, I give you 3 minutes, not for finishing your hamburger, your rice, not to finish, I don't know what you are eating, okay? Maybe it's I don't know what. Okay, but I want that you tell me what is the value of a swap, paying each year 3.65, receiving 6 months. When the new swap, okay, paying 1.65 when the new swap pays 3.65 each year. I wait for your answer, and don't forget my methodology. For people who are a little lost, you wait for the answer given by TWI or others, but today others are a little silent, okay? But some of you were very good also some days ago. So you wait for the good answers, and after you give the same answer, okay? So I go to my message and I wait the first answers. What is the value, the positive value of a swap, which pays during 28 years 1.65 when the new swap rate has moved to 3.65. Nominal value of swap is 100 million euro. Aha, someone is writing. Before TWI. Oh, be careful, TWI. Someone is, I think the price of the swap should be the initial term of the swap. So it should be 1.65%. Okay, just before the other answers, when you make a swap today, paying 1.65 each year, receiving 6 months rate, your swap has a life of 30 years. If in 2 years, your swap in 2 years will have a maturity of 28. So 30 minus 2 is 28, paying 1.65. But now if you make a new swap, 28 years maturity, you will pay no more 165, but now in my example, 3.65%. If you want to sell your swap, to sell it, to say, okay, I sell you my swap. The guy who buys the swap, instead of paying 3.65, he will pay 1.65 because it's your derivative concluded 2 years ago. So he has to pay you how much? How much? So you give me, okay, I'm very happy because someone new is writing a lot. It's Nguyen Hong Lin Bui. Okay, I wait for answers. What is the price? You have a derivative paying 1.65 over 28 years period, and the new swap pays 3.65. What is the swap value? The value of the swap should pay me more than, but less. No, it's not exactly. In fact, you sell your swap. You sell it. You sell your contract. Okay, so you will not to you will receive money today probably, but after it's finished because you sold it. There is no exchange of interest rates for you. You sold your swap. Someone is writing. And now TWI does not want to answer because as I told that she was very good, she said, oh, if I am wrong, it's very difficult for me. Maybe. Oh, I have another answer. Tong Win. The value of the swap will be equal to the present value of the amount has to pay me and the amount I swap with. I think it's not perfectly clear, but the idea is good. I like present value of the amount Vietnam has to pay me Yes, but I would like an answer with figure, but that's a good idea you have here. Tong Win has a good idea. Do you think Tui has disappeared? He's now looking at a movie at the TV? Where is Tui? Okay. Tongwin, who told me a good answer, the value of the swap will be equal, okay, to the present value, that's correct, of what? Of the amount Visa has to pay me. Yes, but what is this amount? Okay, you can sell your swap to Vietcombank, but to another bank also, or to... Okay, really, it's better if you think and you give me an answer, because if I give you the answer, it's not. I like, what is important is to think. It's probably the more complex lesson. After, it's about options, and the options is very exciting. But swap is a very huge market. Someone is writing. I hope I receive a message. I'm looking. Someone is writing. I did not receive yet. I don't know what. Why? Imagine. Um, Okay, I have an answer. Look at NPV, which is a market value of the swap. I agree. Is the present value, I like that, present value of fixed rate minus present value of... Okay. Do you think it's a good answer? Do you think it's a good answer? I have an answer. I have personally an answer, if it's good or not. What do you think about that? Okay, someone is writing. It's close to the first answer. It's more, we have figure here. It's the present value of the fixed leg minus present value of the other fixed leg. I wait for another answer here. Someone is writing about the formula which has just been given. And I will tell you after if it's a good answer or not a good answer. Tong Win is writing. I'm so sad. Tui has disappeared. He was answering every time very well. Where is Tui? Some of you are writing, so I wait, because I like when I ask questions and that you take some minutes to answer. Okay, I tried to present my statement, but maybe I am wrong. I wait for another answer. Oh, sorry, I didn't see. Present value is the aggregate of that divided by... Okay. Okay, so I must address congratulations. to some of you who gave the good answer. Okay, that's a good answer what some of you wrote. So I will send a message which is congratulations. Now, obviously, I will explain for everyone. Okay. Let me explain why your colleague, your friends are good, gave the good answer. Today, 2 years ago, you make a swap, or today, because today, okay, 30 years maturity, we are zero, paying each year, 1 year, 1, 2, 1, 3, 90, 29, paying, as we saw, 165. 165. When I say 165, it's 165% of 100 million. Okay. At the end, 1.65% of, okay. That's the swap today, September, that. Now, in 2 years, it will be 2023. Your swap has only 28 years, okay? And you have a swap between today, it's in 2 years, okay? And year 28, in 28 years, paying, it's your swap, he pays 160, 165, and 165. Okay. But the new swap in 2 years, because the interest rate has moved up, the new swap pays now 3.65, 3.65, 3.65. Okay? And imagine now that in 2 years, I want myself, Professor Marteau, I would like to make a swap. But if I do a swap, I pay in 2 years 3.65. One of you who made today a swap, okay, I tell him, tells me, okay, I sell my swap. I sell to Professor Marteau, I sell my swap, paying 165. Okay, I say, ooh, I am very happy. I buy your swap. If I buy it, I will pay only 165. If I go on the market now, I pay 3.65. You say, oh, yes, but I don't sell my swap for free, Professor Marteau. If you want to buy my swap, you have to pay each year 2% each year, because if you don't buy my swap, you pay 3.65. If you buy my swap, you will pay 1.65. But you have to pay me 2% per year. So the swap value is equal to sum from year 1 to 28 of 3.60% minus 165% times 100 million. 1 plus 3.65, it's a new rate, power t, from t equals 1 to that. And if you discount at 0 interest rates, the value of your swap is 2 million. It's 2% of 100. But as you discount, it's slightly lower. Okay? So if you want to make money, if you are a company, if the interest rate move up, you make today a swap, paying fixed. If the level of interest rates move up, you sell your swap to your bank or to another bank. And you say, In my contract, I pay only 165. Then you pay 365. Please give me 2%. And you will receive immediately, in 2 years, you will receive immediately cash, 2 million. That is the swap value. So the swap value is the present value, as your colleague wrote, that was very good. They wrote present value, some of you, present value of the new swap rate minus the old swap rate discounted. Because the variable rate, the floating rate, to speak as TWI, the floating, is the same in the new swap and in the old swap. In the new swap, you pay 3.65, you receive each year the variable, the floating, and here you receive also the floating. So the floating is the same here. So what's the difference between a new swap and an old swap is just the fixed leg. Swap is very interesting, okay? So if you think that interest rates will move up, sorry, you make a swap paying fixed, receiving floating. I just look if I have some other message. And I don't have any other message. Okay. Someone is writing. One of you told me I try to present it mathematically, but maybe I am wrong. You were not wrong. Your formula was outstanding. What if the interest rate goes down? Oh, the very good idea. The very good question. You will lose money from the swap contract? I think you are very good. Yes, you lose money. If the interest rates move down, let me just come back. You make the swap. Sorry, up. Today, you make a swap. Today, you make a swap. Today, you pay 165. That's the swap rate, which is traded on the market. Okay, 165. Perfect. You receive variable, floating, variable. Okay. Now in 2 years, the 28 swap rate, because your swap has now only 28 years maturity, has gone down, very good question, to 0.65%. 0.65%. If you want to sell it, you want to sell it. You say, oh, I have a swap paying 165. And if I make a swap now, I just pay 0.65. I am not happy with my swap. I will sell it. Nobody will buy it for free. Nobody will buy it for free. If you want to sell it, people will say, oh, if I buy your swap, I will pay more each year, 1% more. 165 minus 0.65. So you lose how much? You lose, if you sell some from year 1 till year 28, 1.65 minus 0.65, discounted, 1 plus 0.65, t, power t, and that's your loss. That's 1%. Okay, you discount at close to 0%. It's something like 1% per year during 20 years, which is 28%. Okay, so you lose a lot of money. That's very interesting what you are asking, because as you lose money if the interest rate moves down, and as you make money if interest rate move up, what is a good derivative you should use? What is a good derivative? Instead of making a swap, what could you do? What could you do? I go to my message, look at the good answers. Someone is writing, what is better than making a swap? What is better than making a swap? If you don't want to lose money if interest rate move down, okay, I wait for the answer. It's a long time for should you buy a call option? You are totally right. You make an option on swap. I buy the right to make the swap. And if the level of interest rate has moved down, I don't do that. If the interest rate has moved up, I exercise my option. This kind of option is named a swaption. Swaption is an option on swap. We will discuss that after, but the idea is effectively options. Is it common to do swap with part of period of the term? You tell me, is it common to make a swap and to sell it before maturity? Yes, okay. It's neither a put nor a call. I will explain after option and swap. Okay, so call or put it. I will explain after. On swap, it's specific. Okay, but I will explain. About the question raised by one of you, is it common to do swaps with part of period of the term? That is it common to make a swap and to stop it, to sell it before expiration? Yes, that's very, very common. Let me give you an example. Okay. Okay. I give you an example. A lot of companies, not a lot of, but very well educated companies. Imagine that in 6 months, you will acquire in 6 months, you make the acquisition of a big company, Okay, in 6 months. And for buying this company, you will issue bonds. You will issue $1 billion, okay? And on a 10 years maturity, 10 years, okay, 10 years. Here, you have 10 years. So you will issue a bond paying fixed, because you want to know the coupon you paid each year, okay? So you will buy a firm financed by the issue of a bond paying fixed, okay? And today here, the 10-year bond, fixed rate bond is assume 2% in dollars, 2%. Okay. So you would like to hedge your company against a rise of the 10 years yield on bonds during the next 6 months. Because you are buying a company. You will buy in 6 months. For buying it, you will issue a bond, a fixed rate, and you say, I would like to pay fixed rate during 10 years because I would like that I know in advance the coupon I will pay. And how can you hedge this the risk you have on the 10 years bond issue because you have a 6-month risk here. If the 10 years yield moves up here, you will issue your bond not at 2% and maybe at 5%. So you would like to be hedged against the rise of the 10 years interest rates during the next 6 months. A lot of companies use swaps. Okay, you call Vietcom Bank, very good bank. You call Vietcom Bank and you say, I would like to make a swap, paying fixed, 10 years maturity, 10 years, but starting in 6 months. And you tell the bank in 6 months, we estimate the value of the swap, the market value of the swap. Okay. Now, in fact, I prepare something like that and I will use my slides instead of writing. Let me just going. Okay. 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 That was exactly the same example as your question. You are the financial director, and all my congratulations, of a US company which will issue a 10-year fixed rate bond in 6 months in order to finance a project. Exactly my example. You want to buy a company, and for buying it, you have to issue a bond, and you want to pay a fixed rate. So as you will issue your bond in 6 months, you have an interest rate risk on the 10-year interest rate during the next 6 months. The 10-year yield for your company is today 2%. How do you analyze the interest rate risk and how do you hedge it? The firm is issuing a 10-year fixed rate bond in 6 months. The risk is that the 10-year interest rate moves up during the next 6 months and that the company is obliged to issue a bond with a higher yield, decreasing its earnings because it forecasts in its planning to just pay a 2% coupon. If the interest rate moves up, you will be obliged to issue a bond paying a coupon higher than 2%, maybe 3%, and you will lose money. Your earnings will be lower. The firm calls, I look on internet, some names for banks from Vietnam, and I found BIDV. Is it a bank, a good bank in Vietnam? Could you just speak? Yes or no? Nobody wants to say it's a good bank. Do you know this bank? Nobody knows? Nobody knows. I look at my message. It's big. Okay, it's a big bank. Fine. So you call a big bank, this bank, and ask for a good hedge. And you say, I would like a good hedge. Trader in BIDV Bank, graduated from CFVG as the best people in Vietnam, has an outstanding answer. Okay, interest swap, 10 years, beginning, starting in 6 months, paying fixed rate. That's a sophisticated but very good answer. If you understand that, before sleeping, you come back on this slide and you you understand very well what it means before sleeping. Entering a forward swap 10 years in 6 months. You do that with your bank. You make a swap 10 years, but the first exchange of flows it's from in 6 months, begin in 6 months. In 6 months, what happens? Interest rate has moved up to 3%. 6 months before, they were at 2%. Are you happy when you issue a bond? When you issue a bond, okay, what happens here? I don't know. When you issue a bond, are you happy? You are not happy. You are not happy. Why? Because instead of issuing a bond with a 2% 10 years yield, you pay 3% on your 10 years bond. What is your loss? You lose each year 1%. 3 minus 2% of I don't know, 100 million or 1 billion, I don't know. That discounted. 1. Okay? And you are very, very bad. Oh, but remember the swap. You have a swap which begin today because it's a swap starting in 6 months, 10 years maturity, paying fixed 2%. You remember. And the market value of your swap has become positive because you have a swap paying 2% during 10 years, and the new swap pays 3% and during 10 years. And you tell your bank or another bank, I sell my swap. I sell my swap, paying 2%. Who wants to buy it? Everybody wants to buy it, a swap, paying 2% instead of 3% now. But say, if you want to buy my swap, paying 2, as if you don't buy, you will pay 3, please give me, it was a loss here, please give me 1%, give me immediately the present value of 3 minus 2 discounted from 1 to 10, which is exactly the same thing. So on your swap, you are very happy. And if you add your unhappiness with your happiness, you are like that. You are good. You are, because you're hedged. You are hedged. Because the loss you have when you issue your bond is offset by the loss, the gain on the swap. Okay? The market value of your swap has become positive. A swap paying 2% each year during 10 years, when the new swap is 3%, has a positive market value equal to the sum of 1% per year discounted. Okay? Exactly the same amount. So the company, in 6 months, sells its swap to Square, we say to Square, and the bank, BIDV, gives it 8.5 million dollar cash. The hedge is perfect. No loss, no gain. Understand that? I will just looking at the second assumption. Okay, imagine now interest rate moves down to 1%. One of you asked me, if the level of interest rate moves down, you lose money? It was a good question. If interest rate in 6 months have gone down to 1%, the firm issues a bond paying 1%. During 10 years, Okay? Its economic gain is the sum of 1% per year discounted. You issue 1% yield bond, you are very happy. Instead of 2%, when you was planning your bond issue, the interest rate was 2%. Now it's 1. You issue with 1. You have a gain of 1%. Be careful each year during 10 years. But you have a swap paying 2%, receiving 6 months. The new swap pay only 1% and receives the same thing, variable rate. So if you want to sell your swap, nobody will buy it. Nobody will buy a swap from you paying 2%. You want to sell your swap, you have to pay 1%. It's 2 minus 1. Sum from t equal 1 to 10 of 1% discounted. And you have a loss on your swap. So if you add the two exposure, you have again hedged. The company square a swap, sell it, and pays the bank that 2 minus 1 discounted times 100 million euro, which is 9.5 million euro, the dollar, sorry, and the hedge is perfect. No loss, no gain, no loss, no gain. In fact, again, on your bond issue, a loss on your hedge, on your swap, and it's zero. So for people who were asking, is it common to do this kind of thing? I tell you, it's common in sophisticated places. That is, if you look at the French companies, maybe we have what we call a stock index with 40 companies, which is the CAC 40. 40 is 40. And our stock index is composed of 40 big companies. And I would say on these 40 companies, probably 2/3 of them, 66%, 2/3, are using swaps and are making swap and selling them before expiration. Okay, because really it's very useful to be able to buy, to sell. A swap is a financial derivative you can buy and sell, and it's very important. But today I see in my consulting activity a lot of firms who say the level of interest rates in the Eurozone close to 0%. In United States, close to 0%, but maybe 1% more than in the Eurozone, are historically very low. We never will find so low interest rates because probably inflation will move up. We just had some figure on inflation this morning in France, and they are very bad. So you can be sure that the interest rates will move up. Okay, so a lot of firms say, I'm sure the interest rate will go up. What can I do for hedging, for hedge? I tell them, buy swaps, paying fixed. Buy swaps. Because if you buy swaps, paying fixed, let me just buy. Okay. Take white. Okay. I tell them, if you buy today a swap, okay, you pay fixed. Today in dollars it's 130. In euro it's close to zero. Close to zero. 130, 10 years. Okay, you do that, and you will receive that 6 months. 6 months. Okay, you don't pay anything to do that. It's just a swap. You will pay fixed and you receive LIBOR, okay? And we assume that the present value of the flows you have to pay is equal to the present value of flows you will receive, okay? So the present value is 0. If interest rate move up, that is the new swap, instead of paying 130, will pay 330 each year. What is the market value of this swap? Sum of 2% each year discounted till 10. Why? Because if today you make swap paying a very low interest rate, you have a prestigious contract, a marvelous contract. You have a contract by which you will pay 1.30% each year during the 10 coming years and receive the 6 months interest rate. If the interest rate moves up, the new contract will pay no more 1.30, but maybe 3.30 and receive variable. But variable in the old swap and in the new swap are the same. That does not change the market value of the swap. What does the market value change is that instead of your contract pays 1, the new pay 3. Okay, then you are here. If you want to buy this one, you have to pay sum of 3%, 3.3 minus 1.30 discounted present value. I don't know, but my pen does not work very good. From 1 to 10 in my example, and times 100 million. Okay, so that's 2 million, around 2 million per year, times 10 year, that is 20 million dollars. 20 million. Okay, so that's and I see a lot of firms doing that. Okay, because it's okay. One of you told me, yes, but what happens if the level of interest rate moves down? That is, if the level of interest rate moves to 0.3%. If you want to sell your swap, you will lose money. How much? Sum of 1%, one is 130 minus 030, discounted during that, T110. Okay, you will lose money, but you can imagine that over the 10 coming years, the level of interest rates in dollar and in euro will probably go up and not go down. So yes, you have a risk. And as I told you, you remember we spoke about call or put for the swap. Let me just come back before the break on these topics. Do you remember this example? You are, no, that's not a good example, sorry. Where is a good example? Okay, this one. You are issuing a bond in 6 months over 10 years horizon, and you make a swap starting in 10 years, starting in 6 months with 10 years maturity. Okay, so here you will, in 6 months, you will automatically end your swap, sell it. Okay, so the problem is that if the level of interest rate has moved down, you will lose money, because today you make a swap paying 2%. If the level of interest rate moves to 1%, you will lose 1% during 10 years discounted. So it's the reason why some firms prefer to make what we call an option on swap, or swaption. That is, you buy the right to make the swap. If the level of interest rates move down, you don't make the swap. If the level of interest rates move up, you make the swap and you sell it you have the right to sell the swap. Okay, someone spoke about a put. Yes, you can say a put because you have the right to sell your swap. Okay, we don't say put and swap. We say okay, a swaption, but okay, but put is okay. Is very good. Okay, so okay, before the break, I go to my message and I invite you to send me some message about what we did, and if you understood very well, if you are well prepared to not for the exam, but for using swaps in Vietnam. Nobody wants to answer. I propose we make the break as soon as I receive an answer, not before. So you can just, one of you send an answer, a question, or something else, but send a message and we make the break. Nobody wants. Nobody. So as nobody wants to answer, we make the break. So we make the break. We here it's around 3:30, so that is, I suppose, 8:30 with you. So we meet in 15 minutes. 15 minutes. It's maybe okay. Maybe for you. Quarter to nine. Quarter to nine. Quarter to nine. Okay. It's 35. It's 10 to 9. 10 minutes to 9, before 9. And okay. And you don't hesitate during the break to send me a message. Okay. So in 17 minutes we meet. 10 to 9. Okay. Someone is writing. Sorry. Someone is writing. Okay. Bye. Okay, I propose to finish. It's close to 9 for you, 9 p.m. It's probably you are tired. Okay, it's just 4 p.m. here in France, but we are also a little tired. Okay. Um, okay. Do you have any questions before we start again? Um, Tell me by message or by speaking. Tell me. Okay. So we finish with swaps, but I'm happy because uh, I think it's financial derivatives we don't teach a lot, and it's a very useful and with a very huge market in United States and Eurozone and United Kingdom and Japan also. So I think it's good if you know what is a swap, how we can use them. I would like to finish swaps. I have two kinds of swaps now: commodity swap and credit default swap. Commodity swap, I remember, it's I remind you, is when you pay a fixed price and you receive a variable price, okay, a floating price if you prefer. That's the spot at the moment you pay fixed. And I have an exercise for you, and you will solve. You take a sheet of paper, you just tell you just 1 hour, and after we are free for an evening, a marvelous evening. So you are a floor chocolate producer. Floor chocolate producer. Why? Why floor? I don't know why. You are a chocolate producer. Sorry. I don't know why floor. Maybe before I would like to speak about floor. Okay, you are a chocolate producer. That's good. Chocolate producer from Vietnam, and you have to buy 3,000 tons cocoa, 1,000 next December, 1,000 next March, and 1,000 next May. Okay, that's more interesting than flows of interest rates because it's related to chocolate, and it's so good chocolate from Vietnam. You want to hedge your exposure because you say, okay, we have already sold a lot of chocolate to France, but in 2022, next year, but the price has been already fixed. When I sell my chocolate, the French stores told me, okay, we are okay to buy from you chocolate from Vietnam, but in 2022, but at a given price, which will not change. So give me a price. So you gave a price, and now you will produce your chocolate. And if the cocoa moves up, you will get a cost of producing, which will go up. And maybe you will lose money selling your chocolate to France because the selling price has been already fixed, and you produce regularly your chocolate with a commodity, which is cocoa, the price of which can go up. So you are well educated, and I have three questions for you. If you are a chocolate producer, what is the time horizon of your age? It's a general question, not linked to I have to buy chocolate in 3 months, but from a general point of view, what is the time horizon of the hedge of the chocolate producer? Second question, what are the different hedging opportunities? How can you hedge your company against the rise of the cocoa? Then look at the futures cocoa quotes. What is roughly the price of a swap paying 1,000 ton fixed price in December, March, and May? That is, you enter a swap paying a fixed price for 1,000 tons chocolate in December, in March, in May. So you hedge by a swap. So that's just one of the answers of the question 2, making a swap. Okay, I give you after the price of cocoa. I have here. I have here, but I cannot. Sorry. Okay. Maybe you put this price on a sheet of paper. December is trading 1,790. March 1,082. May 1,074. July 1,052. And September 1,036. Let me just show you, but we already do that. If you look at the quotation of cocoa, if you are well educated, and you are well educated, you say, oh, the cocoa curve is in backwardation. That is inverted. Normally, you say, oh, the cocoa July is equal to the cocoa December plus cost of carry. And the higher is the maturity, the higher should be the price. And here the market is in backwardation. What does it mean? That means that people on the traders on the cocoa market don't like to sell spot cocoa for buying futures because there is a cost of opportunity. You lose the viability of the cocoa. And if the demand for chocolates moves up in the coming weeks, because Christmas is arriving in France, we eat a lot of chocolate. If you sell spot your cocoa, you cannot produce chocolate for selling it to France. So you don't like to sell spot cocoa. And it's the reason why the market is in backwardation. The other explanation could be that traders think that the cocoa price will move up also, probably because the demand will go up. Maybe the supply will go down, but I don't know yet the supply in the producing region. Okay, so dear students, ladies and gentlemen, now you have a 3-step exercise. I give you 5 minutes and I will answer at each of the 3 questions. What is the time horizon of the hedge? What are the different hedging opportunities? And you have the cocoa futures prices. What is roughly the price of a swap paying 1,000 tons December, March, and May? Is the reason why if you develop a swap market in Vietnam, maybe you are able to create swaps on the rice price, on the wheat price, on the cacao, on the paper. Oh, yesterday, I forgot to tell you that. Yesterday evening, at the French TV, there was something about paper, and I learned that 50% of the global production in the world is done in Vietnam. And they told us we have to be careful because you have in Cambodia essentially very good paper. In Vietnam, some papers are very good, some are bad, and be careful because I did not know that it was a very, very high region for producing paper. Sorry for that, I did not know. I knew chocolate, I knew many things, tea, sure, and many things produced in Vietnam, but paper, and there was on the French TV 1 hour and a half broadcast on paper in Vietnam. That was very, very interesting. I learned a lot of things about paper producing. So you have to create a paper futures market for people who want to buy paper and who want to be hedged against a rise of the paper price. Okay, maybe if my accent is not so good, I will write it's paper. You have, okay, a broadcast in France on the paper produced in Vietnam. Okay, paper futures market. You have to create that. Create a market for paper, because I did not see any futures market on paper, not yet. On the Chicago Mercantile Exchange, they don't trade a futures contract on paper. Maybe you have to introduce that, okay? And you invite me for the conference, the introduction conference on the paper futures market. You say, okay, we have an international expert who is an expert not on the paper, but maybe on the futures market. And you invite me, and you invite me for eating with a lot of paper because I like paper from Vietnam, essentially. Okay, so coming back to the futures, to the swap. Okay, you have 5 minutes, and I wait for answers. Please, I wait for answers. You answer. It's the end in 35 minutes, so maybe you can. Okay. I wait for answers. Normally, some of you should already have answered. Okay, I received some answers which are interesting and, in fact, very good answers again. So I wait maybe for another answer before giving the answer to all the class, but someone gave us a very good answer. I just wait. Maybe 3, because it's 3 again. You can try to price the swap. What is the price of the swap? Do you have any idea on the third question? One of you is writing. I don't see yet the answer, but okay, I'll wait for the answer. What is very important is to work also by yourself, you know. Okay, looking at the slides, but very important to do that by yourself. Should hedge for the term from now until May. Okay, another answer. It's a different answer from the answer given by Tui. Tui told us flexible horizon as long as it's longer than May. And you say should hedge for the term from now until May. Okay, what I understand from the answer given by Tui is that we can hedge over a longer horizon than May. And you say our time horizon is no longer than May. Okay. Okay, another should hedge for the term from now until May. Buy forward, second question, buy forward, pay fixum for swap contract. Yes, not bad. Okay, I can read the message, and I read the message, I answer, and after we go to the slide, and I give you the answer. So the first question is, what is the time horizon of hedging? And some of you say May 2022, and one of you said more than May, longer than May. In fact, it's a very important and strategic question. Sure, you have to buy you have to buy what was cacao in December, in March, and in May. But in reality, after May, you will continue to produce chocolate in 2023, 2024, 2025. And the strategic question behind hedging, because hedging is not only a technical question, it is a technical question, but the strategic question is, what is my time horizon for hedging? And let me explain, for instance, that Air France airline company decided some years ago to hedge the oil price risk, the energy risk, over a 5 years horizon. It was not just because I have to buy oil in the coming months. It's because the general management said, in 5 years, we will use our planes with energy, and we have a risk which is maybe 5 years, but maybe 10 years. And the question behind, if you go to after 5 years, 10 years, 15 years, finally you can hedge the company against the change not of its earnings, but of its value. And you have behind here, but I don't go into details now, a strategic question. Do I hedge my future earnings till which horizon? Or do I hedge against the change of my value? And my value is maybe the discounted cash flow over an infinite horizon. So it's not an easy question. So from a technical point of view, because you know that you have to buy cocoa in December, March, May, your time horizon is May. But from a strategic point of view, if you are a general manager, you can say, I would like to be hedged over a longer horizon because I will buy cocoa in 5 years, in 10 years, maybe in 20 years. That's very important, and that's a strategic question. Second question, how can you hedge? In fact, you have 3 basic ways of hedging. And one of you said, gave us a very good answer. You can buy futures contract for December, March, and May. Yes, I buy. I buy forward or future expiration December because I have to buy cocoa in December, March, and May. So you buy a series of futures. That's a good idea. Buying futures. That's the first way of hedging. Second way is I make a swap with the bank paying fixed price. Each month in December, in March, in May, I will pay the same price. I am hedged also. So understand that you can analyze a swap, a commodity swap, like a series of futures. Okay, it's the same thing. Either you buy a future December, March, May, or you make a swap. The difference is where? The difference is that if you buy futures at different dates, December, March, May, you will not pay the same price. That's the only difference. If you make a swap, you will pay the same price in December, March, and May. It's a swap. But normally the 2 solutions are equivalent. That's the third question. And the third solution for hedging is option. Instead of buying a futures, you buy a call. You buy the right to buy the future. If the cocoa price moves down, you will not exercise your call. You will buy your cocoa on the market at a lower price. If the price moves up, you will exercise your option and you will buy the cocoa at a cap price. So the pretty good answer here was buying futures, making a swap, paying fixed, or buying an option. Some of you told the same answer, buy forward contract or pay a fixed sum for swap contract for 1,000 tons due next December, next March, next May. That's a good answer. Maybe just option was missing in this answer, but it was a very good answer also. About the time horizon, question 1, some of you say less than 2002, other longer, depends if you have a technical or strategic point of view. Okay, fine. About the third question, what is the swap price? Have you any idea? I would like to give you 3 minutes for I will go again about my question here. Okay. Look at the futures quote. We look. Okay. Okay, what can you do for hedging? You can buy futures and lock in a price of 1,790 for December. 1,782 for March. Okay, you lock in this price. And for May, you lock in a price of 1,074. So the first hedging solution is to buy 3 futures contracts on the Chicago Mercantile Exchange. A December 21, futures contract, a March 22 futures contract, and then a March 22. Each contract on 1,000 tons. Okay. But another way is to make a swap. Instead of buying 3 futures, you call your bank and you say, I would like to make with you a swap, paying fixed in December, March, May, on 1,000 ton each expiration date. Give me a price for that. You are a trader in the bank. How can you find the swap price? Please, it's not difficult. I'm sure that you are able to answer. Okay. Again, before you write something, you can either buy futures December, March, May at different prices, or to buy at the same prices during these 3 months, December, March, May. What is the swap price? How does a trader at Vietcom Bank will do for finding the swap price? I give you 3 minutes. You have the price here. I give you 3 minutes, and I will look at my message, and I hope that you will find something. I'm sure you will find it. Okay, I have an answer which is less than 1,782. Let me just look at the slide. Less. Why less? If you can answer why less, I would be curious. Why less? Yes, yes, yes. If you look at the message sent by TWI, I discount 3 futures price. Okay, maybe you can write the exact formula you will use. You are very close to the good answer. I think you have the good answer. Okay. Okay. Just maybe I asked you already, but I don't remember. Um, I will ask you a question here. Oh, sorry. Two. Where do you work? Okay, so some of you gave us good answers, and thanks for them. Congratulations. For pricing a swap, it's not difficult. In fact, look at you can do by yourself. Either you buy 3 futures contracts, so you lock in a price of 1,790 December, 1,782 March, and 1,774 May. Or you pay the same price. So you just have to write an equation. Okay, so sorry, I answer on my slide on every question. Time horizon is not necessarily May. Okay, people who say May were okay, who say longer than May were also okay. It's not say May or its financial accounts publication horizon. We can consider that the firm will produce chocolate during many years and can hedge its exposure over 3 years, 5 years, or longer maturity horizon. In this case, the firm can hedge its future cash flows, even not linked to sales contract over a long-term horizon. Even you don't have any sale contract yet, in 8 years, you can say, I will produce cacao in 8 years. So I would like to hedge immediately over this time horizon. What are the alternatives? The chocolate producer can buy a 3 months of futures contract, December, March, and May, on 1,000 tons each, but it can make a swap on the same dates, paying a fixed price. Or it can buy an option. Sorry, I forgot in my solution here. Oops. Okay, or option, or buying call on each contract. By arbitrage, the present value of different futures price has to be equal to the present value of a fixed price of the swap. Yes, it's equivalent to buy 3 different contracts with different prices, or a swap with the same price over the 3 expiration date. So here I put the calculation for you. Cocoa futures, December 1,790, March, May. By arbitrage, the discount value of the 3 prices have to be the same. So if you buy futures, what is the price? It's the first price discounted over 3 months horizon, because it's December and we are in September. So divided by 1 plus yield power 0.25, 3 months, okay? Plus 1,782 power 6 months, it's 0.5, plus 1,774 divided by 1 plus yield times 8 divided by 12, that is the maturity of the contract. But you say for pricing, Okay, you say it has to be equal to the swap price F, okay, for each expiration date. So F divided by 1 plus yield power 0.25 plus F divided by 1 plus yield 0.05 plus F divided by 1 plus yield power 8 divided by 12. We solved that, and I chose a yield of 1%, which is roughly the interest rates in dollars, and you find 1,082, okay, roughly. So the chocolate producer can buy 3 future contracts or enter a swap paying fixed price of 1,782 per ton. Okay? Is there any question about that? I think that most of you found the good answer. No question? Okay. Okay, we finish the lesson on swaps, and the next lesson, I think tomorrow, we directly begin by options. Options is really very interesting. And we have 2 last sessions tomorrow, and I think at the end of October. Okay, we don't meet during 3 weeks, I suppose, and I think that the last lesson is at the beginning of October. It will be good. Okay, you have time to read the slides, and okay, about the slides. What I will do is, as I did this morning, I will send you the slide of each session before, and after I will give you all the documentation with all the slides we used. Okay, so you will get everything. Next. Oh, next. Okay, sorry, I have questions. For question 2, option 2, when you do a swap contract, you pay fixed price for buying cocoa. Yeah, sure. So what do you receive? Okay, back. Okay, good question. Okay, for the question 2, you make a swap. Okay, let me just find white paper. White. Okay, I have. Okay. Thank you for the question. Interesting. Okay. When you make a swap, okay, December, March 22, and May 22, and December 21. Okay, I say the present value of the 3 futures price has to be equal to the present value of the fixed price of the swap. So you will pay that each month. Okay, in December, March, May. But the question is very good. The question is, oh, Mr. Marto, a swap? You thought that is an exchange of flows. Where is the other flow? That's a very good question. You know, when we speak about swap, in fact, we just speak about the fixed, what we call the fixed leg of the swap. Okay, because the variable, okay, if we pay the fixed, we say, okay, the fixed is 1,782 and against variable, but we don't say against variable. So I answer because it's a good question. In fact, when you make a swap on cocoa, you pay fixed and you receive here the floating price, floating or variable price. What is the floating variable? That's the spot price in December, the spot price in March, the spot price. Okay, so you pay, you receive here, spot. What does that mean? Example, in December, the chocolate price has moved up to 2,082. Okay, the cocoa price has moved from 1,782 to 2,082. What does happen? What does happen? You pay your bank you pay that because you pay fixed. You pay 1,782, but you receive from the bank 2,082 because it's it's a spot price of cocoa. So the bank gives you $300. And what do? As you are a chocolate producer, you buy your cocoa on the spot market. You don't buy cocoa from Vietcombank. I suppose that Vietcombank does not produce any cocoa. It's just what we call a swap with cash settlement. You pay or you receive the difference. So if you make a swap with Vietcombank, paying it 1,782, receiving the spot, if the spot is traded in December at 2,082, the bank, Vietcombank, gives you $300. And what do? You buy cocoa on the spot market because you are a chocolate producer on the spot at 2,082. And your buying price is that. And finally, the cost of buying is you pay on the spot that you receive from the bank 3, so your price is 1,782. So that was a very good question to understand very well swaps, and thank you to the person who asked the question. Imagine now in March the price has gone down to 1,582 spot. What does happen? You pay to the bank 1,700. You receive from the bank 1,500. So you have a loss of minus $200. You pay the bank, but you go for buying your cocoa and you pay it on the spot, this price, because it's a spot price. You pay that on the spot, you have a loss on your swap, and the cost of buying is a gain of 1,782. So the price can be what it wants, the spot, what it wants, the cost of buying will be this one. Okay? So if you don't want to pay, if the price moves down, if you don't want to pay 200, you use an option and you say, I make with you an option on swaption, by which if the price moves up, you pay me, the bank, the difference. If the price moves down, I don't pay the difference, but I pay the price, the option price, the option premium, because it's not free an option. You understand that it's not free at all. And you understand that the price of the option price, will be linked to the volatility, because it's the cocoa is very volatile. Its price can move up to 1,000 or to 3,000. The price of the option will be very high, because you can make a lot of money if the price moves up, and you have a very interesting advantage not to pay the difference if the price moves down. So the price of an option is an increasing function of the volatility of the underlying asset. Here it's the cocoa. Okay, so thank you again to have raised this question, because okay, when we make a swap, we just speak about the fixed leg of the swap and not variable leg. But you are right. In fact, you have two legs in the swap, two legs, like someone, he has two legs, okay, and the swap had also two legs, and we say a leg for swap. Thank you very much for the question. Okay, let me just look. Okay, no other question. Fine, thank you. Okay, then I come back to my slides. And I will end the session in, I think, 6 minutes. 6 minutes. Good 6 minutes. With an interesting example. It's a true example, a true story I will explain. Look at the oil price. In June 08, June 2008. It is at the end of the subprime crisis, financial crisis. The oil price in June 2008 had a top of $140. Okay, you remember today we are around $70. And at this time, and my story is true, the airline company, Air France airline company, was in a big trouble because they said if the oil price moves up again, we are dead. We make default. We cannot pay the energy at this price during a long time. So maybe we have to hedge our commodity risk. And they said, one of financial department said, we can make a swap, paying fixed price, receiving, I don't forget, receiving spot price. And Air France decided to make a swap, paying each year, in fact, it was each month, because it buys oil each month. 1 month, 2 months, okay, till 60 months, 5 years, okay. They make a 5-year swap, paying $140, receiving each month the spot. And look at the picture. They make this swap here, paying fixed, 140. 6 months later, in December, I know very well this case, so I know. In December 08, the oil price moved down a lot because Lehman Brothers defaulted and it was a big trouble in the economy. The oil price moves down to 40. And then Air France had a swap with a maturity of 4 years 50 because it made in June a swap 5 years paying 140. 6 months after, its swap has 4 years and a half maturity, pays 140, when the new swap pay only 40. That's really not comfortable for the French airline company. And some competitors did not make swap. So they could have a commercial advantage by lowering prices, for instance, because they paid a lower price for oil, and Air France paid every time 140. Because in the swap, when the price moves down to 40, with the bank, you pay 140, you receive 40, you pay $100 to the bank. You buy your oil on a $40 price, okay? But you have to add your loss on the swap. And the price is ever $140. So it was really not comfortable. It's the reason why Air France decided to sell its swap, to sell it. But what is the price? If you want to sell a contract by which you pay 140, when the new swap pay 40, you have a huge loss because nobody wants to buy for free your swap. For free, I can pay 40. If you want that I pay 140, you have to pay me how much? Sum of 140 minus 40 discounted from t equal 1. It's 1 or 5. Okay, 1. Okay, till 4.5 years around. Okay. Discounted is here. It was a loss close to 600 million euro. They sold the swap with a 600 million euro loss. It's a hedging loss. And I finish my lesson by showing you what did the chief executive officer of Air France at this moment. Okay, that's in the financial accounts of Air France in 2009. The chief officer of Air France wrote the second half of 2008, and particularly the last quarter. Okay, the last quarter when the oil price moved down to, in December, to $40, was hit by the full force of the global crisis. To this was added the sudden and sustained downturn in the oil prices, which penalized our fuel hedge. Exactly what I taught you. The financial year saw stable revenues and an operating loss of 129 million loss, but the net loss was in fact 814, since the collapse in oil price required us to recognize in our financial statement the decline in the value of our hedging instrument. They sold, in fact, their swap. They affected both our result and our shareholders' equity. So hedging is a very strategic activity, very strategic. It's not just a technical issue. It's a technical issue. But if you want to have a good idea with a strategic idea, it's better to know the technical issue before to have the strategic issue. Okay. Do you have some questions before we leave? Because you go to what you want. Dancing, maybe, or not. I don't know. Okay. In France, to this evening, we have a soccer competition. It's a European Championship in soccer with Paris. I don't know if I will work. Okay, can you send me a message before we leave? Did you understand the swap done by Air France airline company? That's very interesting. Nobody wants to write because people say, oh, if I write, you will speak a lot and maybe we don't stop. Oh, yes, someone is writing. On my screen, I see someone is writing and I have to wait before someone is writing, but I receive the message 1-2 minutes after. I don't receive. And again, someone is writing, but I don't receive anything. The good hedge for Air France airline company would have to make an option on swap. I understand. Can you share more about how we can create futures for paper? Yes. Maybe not yet, but another time. Creating a future market, it's not so easy. You know, I make a contribution to the creation in Paris on the future market on wine. The name was WineFX. We introduced a future market on wine because the price of wine. We'll write wine. We introduced futures market. Wine. The name was WineFX. You can create a futures market on everything. Okay, so I don't know. It's not a joke. I don't know. Maybe we. It's not difficult to create a futures. About wine, it was a little difficult because the quality of wine is very different. Yes, sure. The quality of paper is also different, but you have to identify a region and say, okay, I will make a price on the paper produced in this region, and exactly as we did for the wine. Um, why not pepper? Do you know if the price grocery? Okay. But decreasing with volatility or decreasing without volatility? Because you know the oil price has been also decreasing a lot, but is very volatile. So no, you have interest to create a futures market on paper. It was not a joke. It is serious, maybe, I don't know. But we have to make studies before on the volatility of paper. Oh, you saw it on TV. Oh, you did not see the same broadcast as us, maybe. Okay, so uh, my I would like to okay to read your message again. So before leaving, send me a message about what you want, paper futures or what you want, chocolate future, cacao future, it exists. For people who want to go out immediately, they can go out, and I tell them good night, good evening, and see you tomorrow. For people who want to express something on the message, you send me a message before going to your activities. And for everybody, I am very happy to see you tomorrow. Okay, bye bye. I read the message you send me now. Okay, so bye for the others, and I was happy to discuss with you. Bye bye.